don't we get started? My name is Nick Hill. I'm a mortgage agent, real estate investor, and just a friend and a fan of both Jesse and Dan here.
And my name is Daniel Foch. I'm a real estate broker in the Greater Toronto area. Spent a lot of time documenting the urban exodus of capital and individuals out of Toronto. So we're really focused on suburban markets, economics, and have sort of evolved as a bit of a media commentator around what's happening in that. I think because most of the sophisticated agents end up being from the city. So the media has been looking for somebody with that level of analysis in the suburban markets. And I also host a weekly Twitter space. So for those of you who are looking for more live events like this, every Thursday at 3 p.m. Eastern Standard Time, we have had Jesse on it. It's a great podcast. Great live event. Tomorrow's episode is coast to coast analysis. So we'll have different realtors from cities across the country getting an understanding for what's happening in the market right now. And the last piece that I'll plug is that Nick and I are co-hosts of a podcast. We will be transitioning it to a real estate investment arm of the Canadian Investor Podcast coming in July 12th of this year. That's when we're going to be starting. So, stay tuned for that. Jesse.
Yeah, thanks, gents. Jesse Bobrowski with Calvert Home Mortgage. I am a partner in the VP of Business Development for Calvert Home Mortgage. We are a mortgage lender operating as a mortgage investment corporation. Our focus as a lender is to support real estate investors who buy, renovate, and sell, and buy, renovate, and refinance. We really enjoy assisting borrowers with short-term mortgages, and real estate investors are a big piece of who we lend to. We believe in empowering our stakeholders through education. And a big thing of what we do is we're blessed to know great people like Dan and Nick and be able to share some of what we know in an effort to aid the audience to make good decisions for their financial success.
Yeah, absolutely. Love that. So a few things we can, we'll just dive right into there. Jesse and Dan, why don't we just go high level talk about what a MIC is?
Jesse,
sure. Sure. Maybe I'll start it off. So a MIC is, again, Mortgage Investment Corporation, and this is a CRA structure. So there are some rules around how a MIC must operate, and the two biggest is it must lend on its assets must be mortgages, and at least 50% of those mortgages must be considered residential. And it's essentially a flow through in that it doesn't pay corporate taxes. All of the earnings of the MIC flow through to their shareholders on an annual basis, and then the shareholders will pay taxes on the interest income they earn. So it's a fund of mortgages that operates, and it doesn't pay corporate tax, yet all its shareholders pay income tax on the interest earned. That's in general how it works. And our industry has really become more formalized over the last 20 years as OFC has created bank restrictions. More and more lenders are looking for the alternative route, and MICs have grown. Depending on the numbers you look at, and keeping in mind most of them are privately held, but 5 times in terms of market size in the last 20 years. There are still private individuals who lend their money. We call that private lending, whereas MICs are alternative lending. So, as banks further and further restrict how they lend, MICs have come in and found opportunity to serve Canadian borrowers predominantly on residential lending.
Yeah, that's a great explanation. And maybe Dan, you can take this next one. Why is the MIC such an important why does the MIC play such an important role, especially in what you and your organization does, Jesse, which is essentially fund real estate investors and flippers?
From my perspective, I think it's very much a scale vehicle, right? Like, we know that a lot of people who maybe own their primary residence, as an example, get trapped by debt service ratios or whatever it is. And so that there's a limited ability on the credit side, let's say, to borrow beyond your primary, or maybe primary plus one rental property, let's say. And then eventually you can get to a point that's called rental wash. So with a lot of A lenders, you might have 6+ units or 4+ units, I think, on the low side, where they'll actually let you claim 100% of that rental income. But when you're starting a portfolio, so when you think about portfolio strategy from the ground up, they're only going to let you claim 50% of that income for your underwriting. And so this creates challenges, obviously, for individuals in the real estate investment who, in a lot of cases, want to scale. It's funny because I've always said that real estate investors are really, in one fundamental way, different than anyone else who interacts with real estate, in such that we have a willingness to borrow B-side credit, right? Because everybody else seems to feel like there's this stigma around borrowing on the B side. It's like the least Canadian thing you can do to borrow outside of the chartered banks. But the reality is B-side, in a lot of cases, like for self-employed individuals, as an example, people who work in the real estate profession, I can go to the B side and I can get underwritten on my gross income, which is vastly different than my net income. And it's literally different than my net income. So for individuals like contractors, as an example, who are doing a lot of flip projects, or individuals in the home design space, et cetera, you can do stated income deals on the B side that allow you different, I guess they're underwritten differently because they're not regulated by the Bank Act and Basel III lending requirements that the chartered banks are, which is designed to limit risk, obviously, right? So you get a little bit more capitalistic and creativity on the B side.
Yeah, just to speak to that quickly, I myself am a mortgage agent. Not so similar to what Calvert does. I play more in the traditional space. And I'll tell you right now, the minute I bring up a B lender, the look on the person's face changes, because the word B is just associated with not as good. And in my eyes, I'm like, this could actually be a lot better and a lot easier for you. But, it's all perception.
I say it all the time, like I'm a real estate investor, and, for my age, I think I have a pretty decent number of doors, and I rent. So I'm not ashamed to say that I rent my primary residence. And I also have never borrowed from an A lender. So those are two fun facts about me. And I think that we need to destigmatize a lot of that.
Yeah, it's really interesting, Dan, when you mentioned scale, we are fortunate to do business with real estate investors who have extremely high credit. Like our average credit score is in the 700s now, who make really great income, who can service our debt, but they are looking to borrow in a way that just doesn't meet what the banks want. Like for our borrowers who buy, renovate, and sell and execute that at scale, banks don't want to be lending to people for 5 months at a time. Right. Banks also see risk when there's an appraisal and the home is in really rough shape. You got a hoarder house with a lot of deferred maintenance. Banks don't want that. Real estate investors, all they see is opportunity. And turn, us as a lender, all we see is, holy man, look at how much profit is here for this borrower. How can we help them? So there's definitely a stigma, but as the investor educates themselves and becomes more sophisticated, they understand how to use the various tools.
Yeah, for sure. And I think it's especially interesting when you're analyzing, using the example of the bank sees an appraisal and they see that this house is a gut job, and the appraiser is always going to overstate the cost of that because they have to, by law, use market evaluations on what that is. So they're depreciating the value by how destroyed the house is, but they're also using a replacement cost new in a lot of cases to establish the value of the home. And so there's a lot of money to be made from GCing a job well. And this is one of the things that Joey's going to talk about a little bit once he has a chance to get on. But getting an understanding for where those spreads are in where the money can be made in creating value in real estate investment and flipping, especially, or on the BRRRR side. And a lot of individuals think about flipping, like they miss sort of what the fundamental driver is from my perspective of where that value creation is. And to me, at least in the current market, and and I'm speaking a lot with the perspective of the Greater Toronto Area, values have accelerated so much that young people, or most buyers, to be honest, the marginal buyer can't afford to purchase a house and renovate it, right? So as a flipper, you're actually creating a credit product, right? You're giving people access to those renovations on a vintage home. You're upgrading a vintage home, and then because they can go and buy that now renovated home with credit at a 80 or 90, 95% loan to value mortgage as a first time buyer or primary residence, they didn't have to pay for those renovations cash. And that is an important distinction to be aware of, because, you know, that's the value that flippers actually create for the market, rather than, you know, being demonized. That, but what we're doing is we're improving the value of the affordable housing, right?
Yeah, that's a really great perspective. You know, I always look at it where, as well, they're creating housing stock. Like people, the general market wants nothing to do with that rundown house.
Right.
They don't want to live there. They don't want to take on the renovation risk. They don't understand the opportunity. And these real estate investors are going and seeing opportunity and creating housing stock out of something that, in most instances, is not habitable.
For sure. Yeah. And so I think like one of the big elements is getting an understanding for where you can add value. So, you know, we use AVM in a lot of cases, which is automated valuation. And you can check this on House Sigma, et cetera, Zolo. And I've spoken with some individuals like, Jason Billingsley, I interact with on Twitter a lot from Zolo. And him and I had this discussion about what is actually the biggest value add that you can do as an individual to a home. And interestingly enough, based on the AVM across, and this would be nationwide, a bathroom is actually, you know, bang for your buck, the best place to add value to a home. So if you have a house, even like one of the biggest things I'll say is if people are looking to spend 10, 15 grand on a home, putting an extra bathroom in the basement is an easy way to do that. And the reason is because when we evaluate, and this is just a psychology thing that's worth thinking about if you're thinking about the house that you're renovating, you have to think about who you're selling it to. And the way that you're marketing that product is people search for homes based on bedrooms and bathrooms, right? And in a lot of cases, you know, if you're adding that extra bathroom, it ends up getting pushed into somebody's search criteria that it might not have been before. And as you climb in that search criteria, you're climbing in the buyer categories or the buying power of the end user that you're selling the house to.
Kitchens and bathrooms remain the number one. I think, you know, it's obvious, go in and, you know, slap some new white or gray, I guess, is the new color to put on all the walls. But
gray is the new white.
Gray's the new white, yeah. But I mean, Dan and I are working on a project right now, and one of the main things we're doing, you know, though it was no question, full gut renovation on the kitchen, add a bathroom and bedroom downstairs, and not only is that a major differentiating factor, but it goes again back to that psychology. If someone walks into a home and it's mostly done, but they, you know, the kitchen's old, when they are immediately adding another $60,000-$70,000 in their head to that sales price. I think that's a good segue, fellas, to move on to, let's talk about running the numbers. What does that mean? What does that look like? What numbers are the most important to run? Jesse, why don't we start with you on that?
Running the numbers is something conceptually simple, yet in practicality and execution is strangely difficult for some investors, especially the new ones.
And I think just getting harder and more volatile as the days go by.
Oh, it totally is. It totally is. So, you know, starting with understanding your budget, right? What are you doing to the house? But also the why. Why are you doing it to the house? Like, you know, you want to add value. So what Dan had mentioned is, you know, cleaning up a bathroom or adding a bathroom usually adds a lot of value. So adding $10 square foot hardwood versus $5 square foot hardwood is probably not adding that much value. So understanding your renovation budget and how it's adding value to we call it the after repaired value. But most importantly, understanding what that after repaired value is. And in order to do that, you need your comparables. It is, the more generic the house is, the easier it is to find comparables. The more unique it is, the harder you're going to find comparables. And in a market where activity's slowing, the market that we're in right now, it's going to be more tricky to find comparables. And also, in this market, it's unique because now you got to think of, okay, if you're looking, for instance, and you find a comparable from March, peak market in some areas, where the HPI went down, versus today up to 10, 11, 12%, you have to adjust for that because you're in a different market. And so running those numbers, getting the expert advice on what is a real comparable, using your realtor's knowledge, but also challenging your realtor, right? Like owning the process. A lot of realtors don't have expertise in after repaired value. A lot of realtors don't work with flippers. So in turn, you the investor, you the business owner, need to really challenge every assumption and make sure you know your numbers inside and out. And that happens over time. There's great tools out there for running your numbers. Calvert produces at no cost a flip analyzer that has a lot of automation to it. And make sure you think through, you'd be amazed how many real estate investors in Ontario forget to add in the land transfer tax. That's a big line item.
There goes 10,000+.
Yeah. Or forget to, oh man, when I sell this, I have to pay a realtor fee as well. Like just thinking through every single cost, so you can really know what your net is. And the amazing investors who are wildly successful understand this inside and out. Those that are getting started, it's part of the learning process. And to have good people around you to challenge you, to give you the info is critical, and not let you, run and misstep because you've overlooked something significant. So taking your time to really understand your numbers is critical, Nick.
Sorry, I might just inject there. I wanted to get an idea for what is like roughly would be good numbers, because you do have that flip analyzer tool, and I put the link in the chat here. What roughly are good numbers for a flipper? Like what margin should they be targeting?
So every flip is different, but I'll look at we like those generic properties where your standard neighborhood. We are the flippers that are most successful are buying at average home value for the market and under. So for let's say your average flip that we're seeing in a market like London, where they're buying a 1,200 square foot bungalow, for 6.5, 700 grand. Usually the renovations are going to be predominantly cosmetic. Like you're not going to be adding. A lot of these flippers don't want, time is of the essence, so they don't want to do a big additions or structural renovations. So usually their budget's going to be between 50 and 75K. And then they're going to exit that in the high nines, and hopefully make, for something like that, they're going to be in and out, and let's call it 5 months. And ideally they're making a floor of 40, and, 40 would be hitting a single, 80 would be hitting a double, and most hit singles and doubles. Right. But you do have some that come in and they just get a sweetheart deal. They clean it up, they paint it, and they're out in a month.
And timing could be, great there too. Like if you're getting that sweetheart deal in 2020 and flipping it in January, February of this year, then you were doing great.
Yeah, where you're seeing massive appreciation. But when it's a tighter timeline and less budget, it's okay to make 20 grand. So the way that I like to explain it is don't buy a job. So make sure you're really making some entrepreneurial profit. Figure out, okay, this is going to take me 100 hours. And for, 5,000 or even 10,000 of profit for 100 hours is probably buying a job. Never mind the risk. Now that we are seeing that markets can correct, these projects carry some risk. So you want a contingency. If the market does slip 5% by the time you buy and sell, there's still some money to be made.
Totally. And I think that brings up two great points that we'll get into. One, the importance of your team, right? I mean, if you're going in there and it's just a paint job and, cleaning things up, cool. Hire a painter, paint it yourself. But if you're going in there and you're putting a new kitchen in, you're replacing the windows, whatever it may be, there's lead times on that kind of stuff. Appliances are even a big issue right now. You've got to go in and have all, and this is more for the beginner flippers or those entertaining the idea. You've got to have that team ready. You've got to have your Gantt chart, your construction schedule figured out before you even go in. You've got to have a good agent on your side. You've got to have a good contractor. And I think those can be make or break. As far as running the numbers, the Flip Analyzer is a great tool. Oh, great. Okay. We are now joined by Joey, who works with Dan and I. It's a
contractor in his truck right now.
Yeah. You're probably in the Home Depot parking lot, aren't you? You're muted, buddy.
I just left the Home Depot parking lot as we speak.
Nice.
Very typical day for me.
Yeah. So Joe, we were just chatting about as a from a sheer example perspective, how investors can add value from adding a bathroom to a house, as an example, is one of the primary ones that I've identified from sort of the data science side of things. So using an AVM, et cetera. And, I think on paper, and this is nationwide, that would increase the value of a home by, let's say, 30K. In the GTA, obviously it's going to be more, and in sub areas, it's going to be less, but let's say 30K. So, like bare bones, from a cost perspective, what's that going to look like? And then also, if you pay, retail versus wholesale, right? Because I don't know how many individuals on this call would be GCing their own jobs as well, right?
Right. So usually, cost for a GC for your average 3-piece washroom is going to run you somewhere on the low side, because if you're just doing like a sort of lower end flip, it's going to run you about $12,000, give or take. That's the GC cost. If you're a retail buyer, the GC is probably going to try and sell that to you for 20, and then you could sell it as part of your flip as a cost of around 30. So there's probably about a $10,000 profit if you were looking at a flip through my perspective. If you're going to GC it yourself, potentially up to $18,000 to $20,000 in profit from redoing that bathroom or adding a bathroom.
Yeah. And that comes back, I guess the preference to an individual comes back to whether or not people are looking to buy a job. Because as soon as you're general contracting your own thing, then you're exposing yourself to the risk of screwing it up, but also the headaches associated with it. And it becomes a full-time job at that point.
More than a full-time job for most days.
Yeah, for sure.
Yeah, it's funny the difference between, especially, I mean, we've seen construction prices and materials, 20% up quarter after quarter, year over year for the last little while. So actually being able to build in that value from the contractor point of view is huge. I'm sure some people have seen it. There's a meme floating around social media right now where it's, the HGTV contractors, it'll run you about $4,000. And the kitchen will run you about, or the bathroom will run you about $4,000, and then you got the actual quote and it's $17,000. So
right.
I think there's a lot more sticker shock. HGTV is not the place to be getting your numbers here.
But I think one of the important distinctions there is like a bathroom renovation creates value in a home because it's a complicated renovation, right? There's plumbing required, there's fixture installation, there's a lot of rerouting of electrical in a lot of cases. Like these aren't typically things that an amateur can do. If you're talking about putting makeup on a pig, a lot of people can install their click-in flooring. A lot of people can try and do trim work. A lot of people can paint a house, right? And look, at the end of the day, most end users who are shopping for a house are going to notice when it was a handyman special or when it was a DIY job versus when it was done by a pro. So there's from my perspective, there's a lot of merit to that markup when you're working with somebody who's exceptional at what they do. But the bathroom perspective it's pretty rare that you can get that done. The layperson can't really do something like that. A kitchen would be pretty similar. And that's why the markup is evident, right? Because one, they're larger scale renovations. So if you're like talking about a base cost, like Joey mentioned, of $20K, but you're selling that to the market once it's built into the house at $30,000. The reason is because most people look at a bathroom and they're not thinking they can do that themselves, or they're not thinking they can scrape by and do it for $1,000 or $2,000 because of what they researched on Pinterest. Most people are looking at that and saying, "Yeah, I have to spend the real money here," right?
Well, I mean, I think
I always
sorry, go ahead, Joey.
Interesting when I always find it interesting when you see these videos on YouTube of people doing DIY bathrooms in 2 days for under $600. I'm like, that doesn't make any sense. And so I always, bathrooms per square foot, just so everyone knows, are the most expensive renovation in a home. They're actually more expensive per square foot than a kitchen. They're smaller and they cost more money. So that's something to keep in mind. And it bodes when you're selling a home. And as Dan said, you see lipstick on a pig when you're flipping a house versus if it's, if it was a rental, for example. Yeah. So I don't believe in going inexpensive when you're trying to, flip a home to an end user.
Yeah. Yeah. And the one other piece that I'd add there is when I get a call from an appraiser when they're reviewed, because every house is getting appraised right now in the GTA, just to FYI to everybody on the call. An appraiser will call me and they'll say, oh, like after they've been through the house, oh, I noticed the bathroom was updated. When was that renovation done? When was the kitchen renovation done? When were the floors installed? They're going through a very specific list of when these specific renovations were done, because each of those things has an independent value that appraisers use to create the overall value for the home, just so you're aware. And they'll apply a percentage. So if you say, oh, it was done 2 years ago, they'll depreciate it by 2 years.
Yeah, just to add to that, I'm sure most of us here have looked at houses where we've seen the DIY special, the tile work, the countertop installation, the kitchen installation, major things that have been done very poorly. Well, unfortunately, those are all going to have to be redone. And you really hate to see it because someone has obviously spent time and money and it's really going to go nowhere. We've also been seeing those houses sit for quite a while on the market, right? I mean, Dan, you and I know that the nicer houses, the ones that are renovated, are the only ones that are still moving, the only ones that are still getting multiple offers. If you go and try to sell that, that flip that's the handyman special, you're going to run into some issues. You're going to have people offering you under market value. And they're going to be pretty easily able to point to, hey, look at the windows. You installed them yourselves. The tile work is done horribly. I got to rip out the bathroom. So don't make that mistake. Something I wanted to segue to was the importance of multiple exit strategies in a flip, especially in the shifting market we've seen today. Jesse, maybe we'll start with you there. What are you advising your clients? If someone goes in and they're saying, hey, I've got this flip, I can make 50 to 100 grand, I think. Are you saying, yeah, go ahead and do it? Or are you saying, well, let's analyze the possibility of Airbnb or STR or, even a buy and hold for the next 6 months until we see the hike cycle, come to a stop?
So we always want the investor to have a very clear exit, right? Like, here is what I plan to do. It's great to have multiple options, but if they're going to burr it, if they're going to flip it is usually what we tell them. And we find that especially important in a downward market. So, Calvert has been lending to real estate investors for over 30 years. And that has predominantly been in the Alberta market that goes through peaks and troughs every 6 to 8 years. So we're very comfortable lending into a downward market, and our investors in Alberta are very comfortable operating in a downward market. And what we found as it relates to mitigating risk is in a down market, continue to focus on executing the original plan. And earlier we talked about, hitting singles and doubles. Sometimes you strike out. Sometimes you barely break even. Sometimes you might even lose a bit, but in a downward market, it'll be really tough for the people that are fighting the market that bought in February, March, April, and that are going to sell into July, August, September. That's going to be tough to scrape a profit out. But if you get out of it, man, are there ever a lot of, because that psychology has changed? Oh, it's interesting. The psychology has changed into a buyer's market. Yet in terms of actual inventory numbers, it's still a balanced market based on month supply. And I think Dan would have more to say about this, but we're still talking 2, 3, 4, 5 months, which from a fundamental standpoint is balanced. You're not into a true buyer's market, yet that psychology has changed. So our flippers make money when they buy, right? Yeah. Your renovations are great. Yeah. If you're a contractor, you can save $8,000 on a bathroom versus hiring it out. But the profit is in the purchase. And in a market where there's starting to be signs of, in a market that you are seeing depreciating values, that seller psychology has changed, and you could probably get an even better number. So the way that we look at it is multiple exit strategies are wonderful, but we want, like, the best flippers are always clear, or BRRRR clients are always clear on, here's what I plan to do. And yes, I can shift strategies depending on, but typically when you shift from a flip to a BRRRR to try to weight the market, that's where you get slapped around, right?
Yeah.
It's so hard to time the thing.
Yeah, I think that your safety is like the safety is definitely on the exit strategy. And if you think about as an investor, as a real estate investor, I would agree that I think that multiple exit strategies is the best to manage downside risk. But I think that you manage most of the downside risk on the way in. So for perspective, Nick and Joey and I with an investor client picked up a flip late last year with a long closing. And we bought it extremely well for the market. And had we closed in February, we likely would have closed with $300,000 in equity, right? Because of the long closing. And now it's probably after closing, it's probably in the money, right on the money. But so the safety was there, right? Like that it's still priced at market, and the margin would have been there had we closed on it earlier. So I would agree. I think obviously the best way to mitigate risk and is to buy well the same way. And if you stick to the script, like the same thing, I've spoken with the investor multiple times. I've said, look, if the market continues this downtrend, there's a good chance that we're going to hold this thing. We're going to end up having to hold this thing. We don't want to have to pivot to that strategy. And that's why we're going to stick to the original strategy. Like you said, like if you're going into the deal as a flip, keep it as a flip. Because every time, the easiest way that I would explain this, like with an analogy, is if you're driving and you're on a highway, as an example, and some traffic comes up, you're actually less likely to beat your time if you go and try and take an alternate route. You're more likely to get to your destination at the fastest, most optimal time if you stay on the existing route. So there's a degree of efficiency in sticking to the plan, right? I might just jump to a couple of these questions in the chat here. So yes, there'll be a recording. We're going to post it on the Canadian Real Estate Investor podcast once we launch in July. And maybe we'll figure out a way to get the video recording available as well, from Jesse. The best, from my perspective, the best bang for your buck, for flipping and BRRRR is always in markets where the value of a renovation is the primary portion of the valuation of a home, right? So there's a lot of markets in Ontario still, and in Canada especially, but in Ontario even, where you can buy houses well below replacement cost, right? Sault Ste. Marie would be an example. Cornwall, Ontario would be an example. French River, Sudbury, etc. A lot of people don't want to flip in these markets because they're far away and they're hard to find people. But the reality is, if you're adding value in those, you're going to get, on an appraisal perspective, if you want to do a BRRRR, you're going to be able to pull your 80% of that equity. In regards to areas where on the flipping side where the value is, you got to know where the marginal buyer in the market is spending the most money. So markets with stability in the GTA, and fortunately the deal that we picked up that I was just referencing was in the Hamilton area, right? Hamilton has been surprisingly resilient by comparison to some of the remaining markets during this major downturn, right? Like some of the suburbs, York region, Durham region is getting decimated right now by price reductions. So understanding those specific areas where there's potential for future growth, you got to think about who's who you're selling the product to mostly. And this could be, if you're an investor today and you're holding it for a mortgage term, who are you selling the product to in 5 years, right? But if you're planning to exit the product in in 2 to 6 months, then you have to think about who you're selling it to on that day. And today, the marginal buyer, the biggest group of within the marginal buyers was first-time home buyers. As their credit starts to get erased, who's going to be the next major transactor in the market over the next little bit? And it would vary in the micro, right? It would vary on a municipality or geographic basis.
Yeah. So to speak to that, that is the exact reason why we decided and opted to add that full new bathroom and that other bedroom. There's great schools in the area. So again, you look at the demographics, you look where you are, you have that seller in mind. I just want to jump to the chat here for a quick second. We have a live deal going on in the chat. They're doing deals in the chat right now. I love it. Andrew, Welland Niagara off-market deal. I don't have any properties out there. I don't think Dan or Joey do either, but I know a ton of people that there's a massive investment community out of the Welland Niagara deal. I would urge you to just find some other people investing out there and talk to them, or don't even bother and just sell it to Buju right now.
Yeah, I mean, that might not be a bad idea. And we won't even take a fee on it. But I think the Niagara and Welland interest me especially, and it's a good example of what I just mentioned in regards to those micro trends, right? What are different geographies commanding when it comes to buyers, right? So if we're talking about Hamilton, right, it's a great young person city. Barrie is the same thing. When you're seeing the Ontario exodus of people moving to Halifax, moving to Moncton, moving to Calgary, these are very much first-time buyer, second-time buyer, millennial moves, right? When I look at Welland and Niagara, to me, there's a couple of things that really stand out. Proximity to the border is a huge one. And most of the individuals that I know that build product for seniors specifically are building with proximity to the border. There's a couple of different check boxes, but proximity to the border, casinos, old people like casinos, boomers love casinos, right? So you've got proximity to water courses, and you're still close enough to you're within, you can fly out of Buffalo, you can fly out of Toronto to get to your snowbird spot in Florida. And then the other piece is healthcare, proximity to healthcare. See, one of the things so to me, Welland and Niagara, especially, like if you're near Niagara College, yeah, maybe a student rental is the obvious play. But I think that those areas have an exceptional degree of long-term stability, because to me, when I answer that question that I posed to everybody before, who is going to be the next big group of buyers in the real estate market? It is going to be baby boomers who are downsizing out of the 4-bedroom homes that they own in the suburbs, and they're going to downsize into condos, or maybe they're going to downsize into bungalows, and they're going to go to areas like the ones that I just described. So Cornwall, Ontario might be another decent example. Close proximity to 2 major airports. You can drive across the border in 10 minutes, right? They've got a casino right nearby, and they have a hospital in Cornwall. Niagara checks all of those boxes from my perspective as well. So I think that one has a bit of an encoded long-term stability, because it appeals to 2 groups of buyers, right? It appeals to maybe the student rental investor, but it also could potentially appeal to those individuals who might be retiring in markets like that.
Yeah, really well said, Dan. I just add to that building a purpose-built or something for seniors is entirely different than dealing with the student route. So if you're starting out, pick one or the other. Students can be. I rented some lovely seniors. One gentleman who was not so lovely, but the rest of them have been fantastic. Students, on the other hand, I was a student not so long ago, and I remember some of the stuff that my friends and I did. This is long before I cared about real estate the way I did. So my advice on that would just be to make sure, again, reverse engineer that, just like you're doing with everything else. Find who you want to rent to, right? So for Dan, Joey, and I, we know that we're selling this home to a family, right? Yeah. We know it's going to be it's a single family home. We know there's schools right in the area. So we are designing it to be the nicest single family home on the block. Student rental, that's a totally different strategy.
Jesse, I just wanted to get your take on this, like, and maybe because I think talking about downside risk before we pivot over to potentially like the concept of investing in mix, maybe in like 5 or 6 minutes, for a quick one there. What are you seeing? And Joey, this might be a really good one for you as well. Like, can you advise people to mitigate downside risk? Like beyond obviously like the buy well, but like if somebody bought poorly, right? Or they bought at the top, right? Like what are we recommending to individuals to do in these situations? And then Joey, if you want to answer that one after Jesse, sort of just like on the construction side, right?
Sure. So timing is key, getting in and out. Like usually the biggest losses we see is when the market's going down, the individual maybe loses motivation in the project, maybe switches lanes in the project, which adds on time. That is typically compounded because the market usually doesn't correct as anticipated on the upside, but also they're carrying this relatively expensive debt of ours or other private lenders or even bank lenders. And that's where you see things really unravel, where they don't execute. So our biggest piece of advice is execute the plan, stick to the timeline, get it finished. And yeah, maybe if you do decide to own it, at least it's done and you can exit into the less expensive debt, or you have the option to sell. So that's the biggest piece of advice I have, based on 30 years of data and lending out hundreds of millions of dollars into the flip and burr space, is stick with the plan, execute. Time is of the essence. Beyond that, no, I'm just going to leave it at that. That's the biggest piece of advice. And as we have newer borrowers call us and ask our underwriters, who are trusted advisors to them, about what they should be doing, are you sticking with your plan? What does your timeline look like? Still finish it, and then you'll have the options in front of you. But if you sit on your hands, you're usually compounding the negative effects of a downward market.
Well said. Joey, what do you think on the reno side? How are you making recommendations that people mitigate cost risk, like with volatility and material and labor costs?
Well, just like Jesse said, I mean, timeline's everything when it comes to these flips. I would say make sure you either have your GC ready to go and he has everything, all his ducks in a row. Make sure that you trust that GC, or if you're going to do it yourself, make sure all your trades are ready to go. If you run into stuff with the city, which, Nick, Dan, and I all know about, you still need to make sure that that's ready, and make sure whatever add value you're doing to that specific property is in line with that, micro market and who you're planning to sell to. And, take a look at the statistics of the area, what's selling, what's not selling. Are the DIY projects selling? Do we just offload the property, or, are completely renovated turnkey properties selling better and still staying high compared to a lot of the downtrending stuff? I'm not a huge statistics guy like you guys are, but that's, usually the feel of how I deal with things when it comes to flipping homes.
Yeah. It really goes, the pre-work and the preparation is everything on both the financial side and the construction side. Dan,
sorry, I might just add to that, because we were just in that position, right? Like we had a comp that sold at a value that didn't really reflect what we wanted to see the property that we were in worth, right? But it was direct, luckily there was unrenovated.
Yeah. Well, there's a little background story to that as well, that Joey went and did a little recon work, but we don't have to get into all that.
Yeah, but again, this is important, right? You have to see what those things are, right? And we saw this outlier comp, and all of us were like, "Oh, this is bad," right? But then, the reality is the renovated comps are still selling with a huge margin, right? And so. Yeah. Right now, as you're seeing, it's what we call in the real estate industry a beauty pageant market, right? The stuff that really stands out, the stuff that shows beautifully, where there's excess demand for that product still, even though we're in a balanced market, right? So you can see these differences in the micro economy, that there's as credit starts to contract, there's less and less buyers and as credit starts to cost more, there's less and less buyers for the crappy product, because if they have to buy the crappy product, they also got to go get a line of credit or use a credit card or whatever to go do a couple of renovations that they wanted to do. And so that capital cost actually impacts those individuals first. Whereas now all of a sudden there's a psychology. If I'm paying more on the interest, I might as well get everything. I need the house to check more boxes for me because I got to hold it longer. I got to amortize more mortgage. The total interest cost over my first mortgage term is going to be substantially higher. So I'm probably not climbing the housing ladder in this house anymore. Right. Especially the house that we're selling. It's a 3-bedroom bungalow in Hamilton, right? That's a first time or second time buyer home. And so that house, that person is going to want to live in for an entire mortgage term now, because there's no way they're paying down enough principal, and they're not getting the capital appreciation to sell it after year 2, break their mortgage and go buy a 4-bedroom, right? Like that's gone. And so acknowledging that that's gone actually creates more opportunity in the market, because you can really tailor. You're not just riding that capital appreciation. You're really creating value, and you really got to think about it. And that's why flipping, from my perspective, has always been a sideways market kind of thing. It's great in an upward market. Everybody's a genius in an upward market, right? But the reality is most of the value you're creating doesn't come from the renovations. It doesn't come from picking materials. It doesn't come from trimming costs. It comes from the market, right? And now you have an opportunity for it to actually come from your expertise.
Yeah, that's a really good point. A lot of people who believe they were real estate investors, flippers, over the last few years were really speculators and not investors. Yeah. And today we see who really are investors, who's really adding value to the market and able to execute on their strategy. So awesome point with that, Daniel. Yeah. Hey, I'm going to be back in 1 minute. You guys continue talking. Just give me 1 minute. I'm sorry.
Okay, cool. No, it's all good, man. Yeah. We'll flip to the Mick thing after when he gets back. Go ahead, Nick.
Yeah. I was just going to say, so just based off that flip that the three of us have live right now. And again, this is a no money in flip with us. We've got an investor who's financing this. Really, the biggest thing that we did to de-risk it was decide to renovate at the top, right? We are renovating it to be the nicest house. And that was, ironically, the de-risking factor of it. And then now to just touch on that comp that kind of, that number came in, all of our stomachs dropped. We all hopped on a panicked call and probably spent the next hour and a half after that figuring out what to do. Research your comps, guys. If a comp comes in that does not look like it's fitting in with the market, figure out why it sold way high or way low. And ours was low. And, we spent an hour and a half reworking all the numbers and everything to come to the same conclusion until Joey went out and found out why that had happened. And it was door knocked. Exactly. He's doing Joey, why don't you share with us actually what happened with that comp and why it came in kind of shockingly lower than we had hoped?
So basically what happened is I started door knocking, talking to some of the neighbors because I wanted to know what was going on the street. And of course, there's always a neighbor on the street, when you get out with the people, and there's always a neighbor on the street that knows everything about everybody. So I got in touch with, in this particular case, this gentleman's name was Carmen, and he walked me up and down the street and showed me every house that sold, for how much it sold for, who lived there. And he told me the exact story of what happened. And this comp that sold, it sold on a fire sale because they had already sold, the financing had fell through, and the gentleman was in his late 90s and had already moved to a retirement home, and his kids sold off the home to the first buyer just to get rid of the house because they needed the money to cover the cost of the retirement home. So it did sell well under market value. I don't think it's a true reflection of that. And because of everything that sold at recently that had lots of renovations done to it, that calmed, I think our emotions down and helped us, okay, let's stick to our guns. Like Jesse was saying, let's stick to the original plan. This was our plan. This is what we always plan to do. Add value to the home, make it as Dan said, and Nick said, the best house on the street, sell it to a nice, beautiful family. There's a school walking distance. There's a mall walking distance. We know who our demographic is, and we stuck to our guns, and we're going to stick to our guns, and we're going to do well on this.
Yeah, for sure. I want to, I'm going to chat answer Robert's question here. He said, correct me if I'm wrong, capital appreciation will be very slow for the next 5 years or so. I would be surprised if housing outpaces inflation for the next 5 years, to be honest with you. Again, I'm not an economist, but Nick and I did a pretty thorough analysis on what happened in the last rising rate environment, the last 3 rising rate environments, and real estate always underperforms. And the reality is, when we're heading into an early inflation, people flock into it because real estate is seen as an inflation hedge. But eventually interest rates are used to cap inflation, and the impact of that capital cost appreciation. So the delta, the increase in how much interest it's going to cost you to own that house outweighs what inflation is going to do in pulling the real estate value out. And so, if you look at 81, it took from 1981 to 83 for house prices to bottom. If you look at 89, it took 89 to 94 for house prices to bottom. And from that one, I think it was from 94, it took until 2002 for prices to get back to their 89 highs. So 12 years. That was a Canadian basis. But so yeah, I would expect that we're in a market where capital appreciation is going to be slow. But to me, the big thing that people don't realize about that is when you hear it all the time in the investment conversations, buy when there's blood in the streets, right? And the fact that all of you are on here is, to me, is a very interesting reflection of the opportunism in the market right now. These are the markets where you can create value by flipping. These are the markets where you can purchase well on the cash flow or rental portfolio. And the one thing that really happens is investment returns increase during recessionary periods, right? Cap rates are going up and the margins on something like flipping a house are going up. And the reason for that is because right now, most people are thinking construction costs are going up. And so if you're flipping a house into a market where construction costs are still inflationary, but house prices are deflationary, the construction cost is actually what's pushing the value of the house up, because the actual value, the bones of the house are going down. The material value is what's going up. And so you're pulling it up actually by spending that money. And that's sort of, as we're seeing that credit contraction, the values are eroding from the bottom out, right? More and more buyers get pushed down because the buyers who were buying that $600,000 product, as an example, are the ones who get pushed out of the market completely by interest rates increasing. And the people who are in your 1 million maybe get pushed down to 900 or pushed down to 800, right? And so you need to be putting good product into those buyers who are still left in the market. And you need to be buying the product that there's no longer competition for on the low end of the market. So in that respect, there's obviously a lot of risk in the market right now. And so, Jesse, I think we wanted to chat a little bit as well about investing in mix and just sort of what that is as an alternative, because, when we're talking about buying right now, when I talk about cap rates increasing in the market, the only real advantage to cap rate is that you're getting leverage, right? So you're buying a rental property and you're getting leverage to purchase that property. And if you're getting, a 10% cap rate, let's say, mix are often a much safer way for people to invest in or to get exposure to the real estate market and to get a similar return than right now we're seeing in the best cap rate market in Canada would be like a 6 cap, right? 6% rate of return. So do you want to chat a little bit about that? And Robert, I see your final question. Nick and I will actually do a very thorough discussion on Canadians investing in the US. We're going to do that with likely with Jim Chong from TikTok, the famous TikTok US investor. So we'll let you know, make sure to let you know. Maybe if you want to just message me in the chat your email, just so we keep you informed on that. And Jesse, if you want to go ahead on the on mix.
Yeah, sounds good. We can segue into investing in mix, something that we have a lot of experience in. Investing in mix, the way a lot of our shareholders and I look at it, is it's a combination of, it's definitely an alternative investment. It can be looked at as a fixed income investment in a sense, although it does fluctuate. But it is ultimately a debt instrument in which the investor earns interest income. So it's important to consider the tax implications of interest income. They're taxed at your highest marginal tax gain, your highest marginal tax amount. So an investor should think through that if they're looking to get into investing in mix. As we talked about earlier in this segment, the Mortgage Investment Corporation industry has grown substantially over the last 20 years, where our alternative lending industry is really filling a void left behind from banking policy, where some mix are helping new Canadians buy a home where they can't qualify with the banks because they just don't have the credit or employment history that the banks want them to. There's us, where we're really focusing on a small niche in serving real estate investors for short-term mortgage opportunities. There are MICs that do predominantly debt consolidation deals where they're looking to help out homeowners that have a lot of equity in their houses, yet because of their debt situation, their credit score is too low to attract bank money. So there is a bevy of reasons and a bevy of strategies that MICs use. But similar to investing in real estate, it's all about that due diligence. It's all about running the numbers and understanding what you're looking for in a MIC. So a lot of mortgage investment participants right now are operating as almost B lenders. So they're almost an Equitable Bank. They're almost a home trust. They're almost an Optimum Mortgage, a Haven Tree. And they are lending to really high quality borrowers and they're getting rejected from those B lenders for a small issue. Maybe their credit score is a bit too low. Maybe they don't quite debt service. And those MICs lately have returned somewhere between 5 to 6.5% to their shareholders. And then there's MICs that have certain niches. And we've seen MICs return up to, historical averages, 8, 9, 10%. Our fund, based on our strategy, our goal is to return 8 to 10% annually. Our goal is firstly to preserve capital. Me and my partners have the bulk of our financial assets in the MIC. We are invested right alongside our shareholders. We're not interested in writing loans where there's a high likelihood of losing money. So our first goal is to preserve capital. Second, the goal is to provide a really fair risk-adjusted return. And to us, that's between 8 and 10. Over the last 10 years, we've been able to exceed that. We've done just over a 10% return annualized over the last 10 years. So it's important, again, to do that due diligence. And what I recommend the borrower the potential investor to look at is where is the fund's strategy? Where are they lending their money? Is it an urban market? Is it a rural market? Is it on land development? Is it on single family houses? Because depending on their strategy, there is inherent risk in lending on development land versus a standing single family house. You're going to want to look at things like loan to value. What is the average loan to value of the book? So, let's say the book's average is 60%. That means for every $60 million that the fund has out, they're protected by $1 million worth of real estate. You want to look at, especially in this day and age, the history of the management team. Have they been through a downturn? A lot of MICs now we're seeing are relatively young, 10 years or less, predominantly lending into the larger markets in Ontario and BC, where there hasn't been, it's really been a market that's been going up. And similar to flippers who were flipping in those markets that are going up, a lot of mistakes can get masked. And you could look like a genius because the market's correcting your mistakes. So I think that's important to look at as well. And then also, because it's an alternative investment, typically the risks include liquidity. Like MICs, it's not easy to get your money out of MICs like it is the public markets. Although it is a lot more liquid than, let's say, probably owning a piece of real estate, depending on what your perspective is on that. But usually your money's tied up for at least a year at a time when investing in a MIC. You'll want to look at portfolio allocation. We never recommend anybody to invest more than 10% in us. Some of our long-term shareholders disagree and tell us that they should have more exposure than that 10%. But our view is 10% for an alternative asset class that is relatively liquid is probably where you want to be. And it's also the various securities commissions provide guidance on that, and their kind of threshold guidance is that 10%. Kim asked, what is the minimum to get into our MIC? Usually MICs will have what's called an offering memorandum that outlines what the minimum investment is. We don't. We only accept money from what is considered accredited investors. That would mean you either have to earn $200,000 a year or have $1 million net financial assets to invest in us. I always, when I really think about it, I don't enjoy the fact that we are, keeping out hardworking Canadians from investing in our fund. But from a management kind of theory and strategy, we want those more sophisticated investors who understand the risks, who can write bigger checks, because the smaller our portfolio of shareholders is, the easier it is to work with them. When you have 10,000 shareholders at $20,000 a pop, you usually need a fairly robust investor relations team. Those smaller shareholders are typically asking questions, are typically more nervous about their money. They don't have that sophistication. They haven't been through various cycles. So selfishly, we only accept money from higher net worth Canadians. We work a lot with family offices. So these are families that have built extreme wealth through generations and look to deploy that in order to maintain that for future generations. So we work a lot with family offices. We also, as we've grown, we're at $310 million, our fund now. We've worked a lot with discretionary funds. So this is a way to get in a MIC, is find a discretionary fund manager who has a strategy of investing in mortgage investment corporations. And then through that discretionary fund, you can invest in a MIC. So basically, we're working with professional portfolio managers who allocate percentages of funds to us. So again, the key is research. You'll want to look at what the risk of the book is. One of the best ways to look at risk is loan to value. But loan to value doesn't tell you everything, because 60% loan to value on land development is a lot different than 60% loan to value on single family houses in larger urban centers. 60% loan to value on rural properties is a lot different than urban centers. So a lot of times the fund manager will be happy to guide you through these questions, and they should have a lot of frequently asked questions within their materials. So do your homework. You might want to contact advisors, investment advisors, tax advisors, because there are tax implications. It's not, I don't view investing in MICs as like that kind of retail investment, like equities would be, mutual funds, funds of funds, where they're very liquid, they're very safe. So MICs they have a different risk profile, and in order to invest in them, you need a bit of a different investing history and experience, in my professional opinion.
Thanks, Jesse.
Wow, well said.
Nice and thorough. I think we're probably good to, Nick, is there anything else you wanted to cover? And anybody in the audience, is there anything that anybody specifically wanted to ask, either on audio or in the chat, before we start wrapping up here?
Yeah, I'm good. Let's open it up to the audience. Hey, what's up, Alex? Alex is in a mastermind group of mine. Anyone that wants to unmute themselves or put it in the chat before we sign off here? Is there anything we haven't covered or that you want a little bit more explanation on?
I'm assuming that's a good thing if it means that.
I just want to say one thing.
Yeah, go ahead.
Oh, sure, Robert.
You guys are doing a fantastic job, and just wanted to thank you guys for everything you're doing, and great job.
Thanks, Robert. Yeah, I really appreciate that.
Thanks, Robert. Our pleasure.
All right. In that case, we will sign off, guys. Calvert Home Mortgage has a great Instagram page, great website, tons of great tools on their platform. Go take advantage of them. Again, Dan hosts a weekly Twitter space focused on real estate. It's attended by hundreds, if not thousands, of live people. I didn't even have a Twitter before I started attending. So go make a Twitter if you don't already have one, and go sign up for that. You can find me on Instagram at my buddy Nick, and at Daniel Foch, and at Calvert Home Mortgage.
With an underscore after it.
With an underscore after. This has been a pleasure, Jesse. Great to see you as always. I think that's it. Thanks, everyone.
Thanks all. Thanks, fellas. Awesome work today.
We'll talk to you soon, Jesse.